the builders making moves, the projects shaping the culture, the unfiltered thinking behind it all. This is Let's Ride, the weekly podcast from BMX that takes you inside the on-chain world. Welcome to the ride.
Hello, GM everybody. Welcome to Let's Ride, our weekly live stream on the BMX DeFi account. Super excited to talk today with Axe from Autonomint. And we're going to be diving in, doing a demo and showing everything you need to know about the project. Before we dive in, just want to give a quick moment to pass it over to Dees to do our disclaimer for today.
GM, yes, we're going to be diving into some pretty technical DeFi tooling here, and nothing we say today is financial advice. Please do your own research, and we're here for educational purposes. And today we have a very special guest who's building some pretty cutting-edge stuff in the stablecoin arena, as well as looking at opportunities in the options markets. So this one's definitely for the DeFi powerhouses out there, and I'm excited to get into it. And then on the BMX side is we are on the back end of our audit review from a recent contest that wrapped up. So we are just going back and forth there and tuning that up, and we'll keep everyone posted on the official BMX DeFi account on the progress there. But always, excited to one step closer to Deli Swap. But for today, let's get into it.
Absolutely. Well, first, Axe, I want to ask you a question. So would you mind taking a moment to share who you are and what your role is on Autonomint, and how long you've been in the space? I would love to just take a moment to get to know you and share with our viewers.
Yeah, definitely. Thanks, Rachel, and thanks, Tej, for inviting me to this space. And very happy to be here. And so, regarding myself, I have been in this space for around 6+ years, and primarily started in the institutional front, working with some of the multinational uh, clients, specifically in the blockchain space. So they were trying to implement some relevant use cases which were dealing specifically in the financial institutional domain in the derivatives area. And after that, I just met my co-founder in one of the hackathons, and we started working out on one of the products. And I was also a prior uh, head of growth in one of the exchanges, which is based out of Asia, and it's crypto exchange, and they had a pretty good exposure about a lot of different crypto projects who are trying to organize different marketing campaigns and understand.
We lost
might
Axe.
have lost Axe.
Yeah, we're having little technical difficulties today, but let's see how long it takes for him to jump back up. But in the meantime, I mean, while we're waiting for MDs, there's a lot happening on the BMX side. I mean, you briefly touched on the audits, but I mean, we have Deli Swap going live soon. There's a lot we can unpack on the BMX side. So do you want to take a few minutes just to kind of give a little high level updates before we bring Axe back up?
Yeah, for sure. So Deli Swap, we have a ton of educational content that's out there, and we've been beating the dead horse, if you will, of expressing the opportunity and what we're building. But we actually just got off a call with some additional partners perhaps today about stacking even more hooks potentially in the future, exploring those kind of teasers that we had at the beginning of dynamic fees and things like that. So we're already seeing the modularity pay off before we even are live. Just seeing the opportunities of being able to add pieces in the V4 ecosystem.
Right.
But yeah, Deli Swap itself, I mean, the main thing we're excited about is just showcasing WBLT. And that is, it's especially in these volatile recent weeks and times where we're seeing the power of WBLT to stay a little bit more afloat when the market's super red, and then capturing those fees of that extra volatility. And so when that is the base pair of all pairs, we'll really see that shine as far as value capture goes, and then flexibility. You know, when other projects want to get exposure to that kind of versatility, they can simply pair against WBLT, and then it's easy as that.
Well, I have like a little pop quiz, if you will, Dees. Just a couple of things I want to ask you to like just really break these things down into layman's terms. If you could explain in like a sentence or two what WBLT is and what deli swap is, just so we can help folks to really understand that and educate on it as much as possible.
Yes. So WBLT. So it stands for Wrapped Base Liquidity Token or Wrapped BMX token. The B is kind of up for grabs as far as the meaning goes, but it is a combination of Bitcoin, Ethereum, and USDC. And the Bitcoin is the CBBTC, so it's the Coinbase version. And those three tokens are wrapped in a liquidity pool. And it's 30% CBBTC, 20% ETH, and 50% USDC. So that combination is two tokens that are typically volatile, and by I mean volatile, Bitcoin and Ethereum go up and down, and then USDC, which tracks the value of the US dollar. And so when you combine those tokens in that proportion, it creates a hybrid of holding between holding Bitcoin and Ethereum and USDC. And so the price of WBLT will kind of be an intermediary. It won't go as high when BTC and ETH go up, but it won't go as low when they go down. And that's important because not everyone is a trader, but a lot of people want to have exposure to these volatile assets. And so people who hold BTC and ETH for long periods of time, at some point, sometimes they do want to spend money on real things, real life. And it hurts to have to tap into that when the markets are down for weeks or months.
Right.
And when the markets are really hot, you kind of have that other psychological barrier against you. It's like, oh my gosh, everything's great, everything's going up. How could I sell it right now? And that is just a very common psychological conundrum that people have when they're holding these assets and they're exposed to this industry, but they want that long-term growth. And so this asset WBLT provides kind of a padding, if you will, towards those volatile times. And by having USDC in there, typically people pay bills in fiat currencies, and a lot of that is priced in USD terms. So being able to tap into WBLT when someone wants to buy something is a little bit less painful than tapping into long-term crypto assets. And WBLT has these fee generation mechanics. So when we're providing liquidity, it's collecting fees when people are trading those three assets, ETH, BTC, and USDC. And those help grow the value of WBLT comparatively to the underlying assets, which is BLT. I won't get too much in the mechanics there, but the TLDR is holding the token is not just holding those assets and having this padded mechanisms, but it's also it's accessing and holding a fee generating asset. And so people can sleep well at night knowing that thing is always working. And so that's what WBLT is in a high level view. And DeliSwap is a DEX, a decentralized exchange built with Uniswap v4 tooling, which means that it uses things called hooks, which enables us to program certain functionality into the DEX. And so what this DEX is going to do is it's going to pair everything with WBLT. So all those benefits of holding this asset that is more comfortable, we believe, long-term for holders who want to be exposed to the industry. They are exposed to that in every pairing. So say someone likes WBLT or likes BTC, ETH, and USDC, but they also like Moonwell or they like Banker or another token or BMX, they can combine that with that and get all the benefits there. And then the hooks pull out the fees and convert it into BMX and give those back to LPs. And why that's powerful is the LPs now have the optionality to participate in the broader BMX ecosystem, as well as help govern a safety module, which takes some of those fees and puts it into a fund that helps secure the protocol and is there for any kind of insurance policy if God forbid something goes wrong. But I see we have Axe that has returned.
You got Axe back.
If anyone was hanging on my words, please go to YouTube, and we have tons of material there as well as our X account that you can learn all about DeliSwap and WBLT.
Awesome.
Yeah, many apologies for that. Some Riverside server issues, it was just pointing me out. So I had to do some troubleshooting, and but many apologies to the users and yeah, to the host as well. Yeah.
Yeah,
All
so
good.
Ax, without further ado, let's jump into a demo of the product, and then as you're going through the opportunity and the mechanics, feel free to share some of the story of Autonomint and what the use case is, and a little bit of background how we know you guys. You guys have been building for well over a year. This is a has come so far over the years. I actually
Yes.
I found you guys in an incubator program over a year ago, and so super excited about what you're building, and uh, and it's really cutting edge stuff. So excited to run through the demo here and show people some deep alpha. This is deep DeFi trench work. So
Yeah, definitely. What at Atonement we are bringing is a new primitive called as decentralized great default swaps (DCDS). Essentially, the motive is to convert uh, some of the hedging cost, which usually users who are holding these tokens, which are quite volatile, and people generally come in crypto to take exposure to a lot of crypto assets, but crypto as a place is generally very volatile, and right now there isn't any existing tool to hedge against this volatility at a very low cost. So, Autonomint brings out uh, the concept of TCDS, where users can come in and they can hedge on this high volatility of tokens at near zero upfront cost. So, this demo would also be showcasing some part of that, and potentially how users can convert this, uh, earn some high yields through this TCDS product itself. We are also talking about the existing MakerDAO CDB protocol, where users deposit some collateral and mint stablecoin. In our protocol, right now we are a multi-chain product, so we are on Base and Optimism. Once you have connected your wallet here, then you will see two options here. One is the Mint USDA Plus, and second is the Earn with TCDS. In the Mint USDA Plus, it's just simple like typical any other application, CDP application. You will come here and you will see a couple of collaterals which you can deposit and mint a stable coin out of that, which is our stable coin USDA Plus. Now, while you're doing that, so you would be able to mint stable coin, as well as there is something called as option fee, which would be deducted out of your borrowed amount. This option fee's purpose is primarily to provide you an hedge on your token downside. So if I'm depositing ETH here, and if the ETH were to fall 5%, 10%, 15%, 20% from here onwards, then as a user, you doesn't need to be concerned about that. You will be hedged for all of that loss for by paying these option fees, which in fact is not going out of your pocket. This option fees will be taken out of your LTV itself. So rather than getting 80% LTV, you would be getting some 77% or 76% LTV, and you would be able to deposit this and mint stablecoin and get this hedging protection.
all right,
So I've already
let's pause right there
yes,
for X. Just for
yeah,
our viewers that are on the podcast and also who aren't familiar with this stuff. So we just came in here and we said similar to other CDP protocols, so collateralized
yes,
debt position protocols. So
yeah,
you're putting up collateral, you're taking on debt by minting a stable coin. And so with Maker, we'd probably put up, yeah, ETH collateral, right, or other collateral, and then mint. What are we doing now? USDS now for Maker.
yeah,
And then so here we're putting up ETH, but the difference is we're paying this option fee to protect against downside,
yes,
which we wouldn't have with another collateralized debt position protocol, correct?
yes, yeah. So
So
that's one of
what
the core.
happens with another debt or CDP protocol when we have that? What happens if the price goes down by 20%?
Yeah. So if you were in MakerDAO and you were to deposit collateral, then if the ETH price were to go down, then you won't be covered for any of the those loss. So if the ETH price were to fall 20%, then all of that loss is not hedged for you. And if the ETH price were to fall even further, then you would be liquidated, and you might have to pay some kind of liquidation penalty for that also. In the tournament side, that's not the case. If the ETH price were to fall, you would be hedged for that loss. So if you come in and repay back the stable coin which you have minted out, then you will be getting the entire full value of the ETH which you deposited at the deposit price. And yeah, that's one of the major value props which we are offering here, and we can potentially do this with any other token which is existing in the market with a high liquidity bracket.
So if I deposited, say, $4,000 worth of ETH, and it dropped by 10%, I could come back, repay the stablecoin, and would get actually even more ETH. Is that correct? Because I would be getting the dollar amount of my original.
So you would not be getting more ETH, you would be getting more USDA plus. So whatever USDA plus which you have minted out, so rather than paying the full amount of USDA plus, you would be paying a lesser amount, because a part of that USDA plus is now part of your profit from the hedge, uh, whatever ETH price dropped. So 10% ETH price dropped, like $4,000 is the ETH price, and ETH price dropped by 10% to $3,600. So this $400 is the excess amount which you can keep with yourself in our USDA plus stablecoin, and you don't have to pay that amount back. You only have to pay what is the left out amount.
Got it. So the difference is made up with the USDA plus.
Yes. Yeah.
Okay, awesome. Let's continue. I hopefully that was a good checkpoint for some of the listeners.
Yes. And now comes the DCDS part, which is the counterparty, which is enabling this hedge or providing some kind of insurance or protection to the existing hedge which we are providing. So here you can just come in and you can deposit some stable coins or any other volatile tokens like Arrow. And once you have decided, like suppose I have decided to put USDC, or suppose I have saying Arrow, then you can put in those funds, and once you are putting this, then you have to select some kind of lock-in period, which is 30 days, 60 days, and 90 days as per you. And once you have done that, then you would be able to just, that's a simple thing which is required, and you can just look into some of the details here, how much fixed fee yields which you have been earning over the last 1 month, and what was the ETH price change over the last 1 month. This will give an idea to the user that how the ETH is performing, because once you are putting your capital here, then you are mainly acting as a risk underwriter. So for getting this option fee incentives, you would also be taking some of the risk if the ETH price were to fall downwards. So we are just showcasing what was the last 1 month, and you will just deposit here and the position will go through. And so just to showcase some of the positions which I've already done, so yeah, here it is, one of those. So suppose I have deposited 20 USD plus here, and the ETH price at that time was $2,500. And these are some of the details, like what was the time when I deposited and how many days which has passed, and what is the yield still now. So I deposited $20 like around 102 days ago. I have already achieved 23% in yields, which are fixed yields from all the option premiums which I have collected. Apart from that, we are also sharing a part of ETH price upside with the user, which is just like 2 to 3% of the upside, and these are the variable yields which would be showcased here. If the ETH price were to fall downwards, then this variable yields will turn negative also, but you are covered on the side because you are also getting these fixed yields. So yeah, that's how it works, and these are
And
some of the high
and those
yields which, yeah.
and just to clarify, so those yields are coming from the people who are minting USDA and paying those option fees, correct? Plus the variable yields coming from the ETH upside if that collateral is going up in value. Is that right?
Yes, yes, exactly. Yeah.
Okay. And so the best time for someone, I mean, advantageously to deposit into a DCDS, a decentralized credit default swap,
Mm-hmm.
would be like in crabbing positions, or maybe in, obviously bullish conditions if you're holding that asset anyway and you're not looking to take leverage?
So yes, definitely. If you feel that it is bullish and you want to take a long exposure on ETH, then you can come in and deposit here in the DCDS. But in spite of that, if even if the ETH were to volatile and there is some bearish scenario here, still you can come in, and as per our simulations which we have done, if you keep the amount deposit for like 3 to 4 months, then the amount of yields which you will accrue, as you can see here, these are 23% yields on your capital. This would be far higher than what you would be getting out of based of the ETH volatility losses. Uh, so that's just some of the simulations which we have done, and so over the yearly time frame or a 6 month time frame, you would be on a net positive as per se. But yeah, but that's just simulations, and not only simulations. If I have to speak from the last 4 month data, in the last 4 months, the yields have mostly been in the positive side, the net yields, and none of the users have faced negative yields on the DCDS.
That's incredible for the simulations. And so I'm sure a layman user, someone's even been around for a while, like, okay, well, if these yields are coming from the options, from I'm sorry, the collateral debt position minting,
Yes.
and that fee that's coming, we probably need some pretty heavy demand on people using ETH as collateral and borrowing USDA. And so maybe we can explore some of the use cases of why people would want to take leverage. And I've
Yes.
followed your account for a bit, and the the process of getting these arbitrage of selling options, I think, is really fascinating and unknown and kind of complex for a lot of users. But hopefully we can demystify some of that here, because it does seem that you guys have unlocked a incredible potential of arbitrage that isn't really capitalized in the
Yes.
market quite yet.
Yes. So in the current market, most of the yield solutions which are out there, they are mostly from the lending based yields which are generated. So so when you go to a typical CDP protocol and you mint a stablecoin there, then you are mainly paying some interest there, and then you try to utilize that minted stablecoin in some other money market like Aave to earn a higher interest rate on that, and that is basically your arbitrage, and that's how you are earning the yields on the stable coins which you have minted. On Autonomint side, the case is a bit different. We people who are minting these stable coins, they are paying these hedging fees, and but on the other side, this hedging fees is very less as compared to what you would if you were to go to some other options exchange and hedge your ETH exposure. You would be buying something called as put options there. A typical put option on Deribit and and the put option which we are providing, there's a difference of 60%, 50 to 60% in the price difference. So that gives like a 50% spread difference where users can make profit. How they can do that? So when you go to here mint USD plus stablecoin, I have mentioned a couple of strategies here, where if you click on those, you will see all of these strategies. Uh, some strategies are quite simple. You will just deposit ETH and mint USDA plus, and you will be hedged on the downside. We have mentioned what is the typical borrowing rate and in the tournament, and what is in the market borrowing rate. And we have also mentioned the option fees, which is the hedging fees which we are charging, and what is the market hedging fees. So as you can see, there is quite a bit of difference here, and all the other scenarios where you can see if the ETH price were to fall $100, 200 or whatever, then how your yields would accordingly be uh, here on this. Similarly, there are other strategies as well with other collaterals which will be accepting here. But primarily, what I would like to focus on, one of the unique strategies which is only possible through a tournament design, and as of now hasn't been unlocked in the DeFi space, is this option fee arbitrage. In this strategy, you will be coming on to the tournament and minting this stable coin, and you will be paying these hedging fees. And once you have paid these hedging fees, then you are hedged on the downside. now your downside is covered. So now you can go to any other option exchanges like Deribit, and you can sell a put option there. By selling a put option, essentially what it means is that you are going long on ETH, and by hedging ETH on Autonomint, you are going short on ETH. So this way, you are delta neutral, and once you are delta neutral, you'll be able to accrue these premiums by selling put options on Deribit. And because these premiums are higher as compared to what we are charging, so there's a quite a bit of profit which users can accrue through this delta neutral strategy. uh, so this is one of those strategies where users can earn like 4% per month in returns. And some of the pretty advanced strategies are also there with some of the option fee who understand options they are using, and the returns can also exceed up to 10% per month for that.
This is
Yeah.
awesome. You guys, by the way, I do have a hard stop. I unfortunately have to run early for an appointment, but yeah, just wanted
Yes.
to ask you, Axe, like where can folks connect with the project, and like where can they go to get started and use the app?
So yeah, they just need to visit autonomint.com, and there we have our app link, and we also have our documents there. They can read more on that, or they can join our Telegram channel. And I'm pretty much active, quite 24/7, and I can answer all of those questions, whatever they have. Yeah.
That's awesome. I definitely need to do a deeper dive here and try some of this out. But this looks really cool, man. And we're just super grateful for you taking the time today to go through everything. Deez is going to take it from here. I'm sure you guys, if you're watching, pull out your notepads and pens. It's going to get technical, and you guys will definitely learn a lot today on this stream. So definitely take notes. And yeah, best of luck to you guys. I got to jump off. But Axe, thank you so much for joining us today.
Yeah. Thanks, Rachel. Yeah. Nice to
All
talk.
right.
Yeah.
Thanks, Deez. You got it from here.
Yeah, no, absolutely. Thank you,
All
Rachel.
right. Bye, guys.
Yeah.
All right. The parents are gone, Axe. It's just you and I. Now we can do all the DeFi stuff.
Yeah.
So
Yeah.
yeah, so let's dive in even more because we've speed run the whole opportunity. It's crazy. So there's 4% to 10% yields per month is what you're putting out. And I haven't looked on the website in forever, and the strategies that you've outlined, that's definitely new. I haven't seen that before, and it's awesome that now we have these kind of templates, if you will, of how to get started. Is there
Yes.
a way we can go even further step by step? Like, are we capable today to do that? Are you comfortable with doing that? Maybe like going through one of these strategies from point A to point
Yes.
B.
Yes. Yes.
All
Yes. I
right,
can do
yeah,
that.
let's do it. Whichever one you're willing to showcase. Let's dive in.
Okay. So let's do this option fee arbitrage strategy which we have here. So in this strategy, firstly I will be going here uh, and depositing some ETH and minting a stable coin. Uh, so for the sake of time, I've already done some positions. So I've already minted stable coin. Uh, so let me just showcase one of those positions. Maybe on the optimism side, I've done some positions. Yeah.
And so when you say positions, how long are the time frames that people are holding these positions from point A to point B?
So we provide this hedge for 1 month at a time, and there is a 30 days time frame. And so within 30 days, this hedge would be active. But once the 30 days are over, then your position wouldn't be hedged, and you have to renew your positions. Then you basically have to pay some option premium so that you can renew for the next 30 days. But even if you don't want to renew, then also no issues. You can just keep the position open, and it becomes like a typical CDP protocol, where your position won't be hashed, and you have just deposited some ETH and minted stablecoin.
All right, yeah.
Yeah.
So worst case scenario, we're doing like we typically do, and we're at the whims of the ETH price movement. But if not, if we renew our options, then we have that luxury of the downside protection.
Yes. So yeah, And regarding this strategy, so if you have some ETH, you will come here and mint some stable coin. So I've done a lot of positions over time, and these all of these positions are here. So when I've minted some stable coin, then I'm basically now hedged on the downside. This position is basically expired, but uh, if I go to some new position which I've done recently, yeah, this one. So yeah, here I have 25 days maturity left. So I am still hedged for the next 25 days. Now since I'm hedged and I'm covered on the downside, and since my option fees is quite low, which I paid here, so what I can do is now I can explore and go to Deribit. Uh, so let me share my other screen. Just a second.
So for the listeners on the podcast, so the options fees, how big was that ETH position? So we had a $28 option fee based on what was the collateral? One more time.
So yes, so in this position specifically, I have minted uh, 0.009 ETH. It's quite less ETH, and I minted 28.49 USD plus, and the option fees for this is $1.05.
Oh,
But
excuse me.
if I
Yeah, yeah, yeah. Okay.
yes, yes, but if I have to say, if you want to see the option fees, then we are showing here. So for one ETH, this option fees is triple $1, and now this is for one ETH. If you're depositing one ETH, but now here is Deribit. Deribit is a very popular options exchange, and if you were to go to Deribit, then there are a couple of these puts and calls which users can come in and they can trade and buy. And if I go here and choose expiry, which is like around 1 month from here onwards, so today is 1st October, so maybe 31st October, and I choose to buy a put option. So there is something called as puts and calls. When you buy a put option here, then you are basically trying to buy a hedge on that. uh, so this is the put option price which is I would be paying. So as you can see, for one ETH, this is $247 here. But on our side, on the tournament side, this same price is $111. So the difference is like more than 50% in the price difference itself. And so rather than buying put option, because you have already done that on a tournament, you have already bought this put option at a cheaper price and you are hedged. Now you can come here and you can sell the put option. So I can click here and I can just sell this put option by clicking here, and by creating an order I would be able to do that. So I've already done some positions here. So
Okay,
like I've,
let's pause right there just for a second for the
yes,
listeners on the
yes,
podcast. So we went this is awesome. So we minted our collateral position on Autonomint. We're paying an X amount of fees on there. And then we come over here and our position on Autonoment's open for about 25, 30 days. Well, that's how
yes,
long we're protected. And so we come over to Deribit, we scroll over to the 30-day range because that's about how long our position is protected. And so we
mm-hmm.
have that downside protection. So we're going over to the put and you scroll down to the exact 20% downswing. Is that right? How did we find that row?
So because on a tournament we are providing this hedge at the money price, or basically the current price itself. So if you come and deposit ETH from the current price itself, we would be hedging the downside. So you can find whatever is the nearest ETH this price, which is current near to current price. You can choose either 4200 or you can choose 4100. So whatever is nearest to current market price, you can choose that, and you can just click on this and sell here.
Okay, so we've scrolled down to the two rows that are closest to the current price, and we're looking at the put
Yes,
option, and we're looking to sell the put option.
yes,
Okay.
yes. And by selling a put option, basically you are going long on ETH. So if the ETH price increases, then you are essentially getting this premium, and you don't need to be concerned about any losses on that side. You are covered for that. So So this way you would be able to get like $250 in premium for 1 month onwards. And because you are hedged on Autonomint for 1 month, so even if ETH price falls, right? So whatever losses which you will be encountering on this, so if the ETH price were to fall till 10%, 15%, then all of that losses would be covered on a tournament side. But uh, there is a big caveat which I would like to throw here. Uh, we are only hedging your positions for 20% downside. So if the ETH price were to fall more than 20%, then your position would be liquidated on the tournament side, and whatever hedge you had, you would no longer be able to claim that hedge because your position is liquidated. So but since I have already mentioned, you already have the option to renew your position. So if you see that your position has dropped, so if the ETH price has dropped like 19% in the next 20 days or so, then you can always renew your position and you would be hedged on the further downside. So so yeah, so that's one of the caveats, because here when you're selling this put option, when you're taking a long, if the ETH price were to fall 20-30%, then all of that losses have to be bear by you. So yeah, that's one of the things which I meant to mention.
Gotcha. So yeah, under 20%, we have to really keep an eye on Autonomint and then perhaps renew it to extend our downside protection. So here, let's
Yes.
just go with a scenario of ETH drops 10% in 30
Mm-hmm.
days.
Yes.
We have our downside protection. What happens to our put here? Are we're losing money on the put? We're
Yes.
making money on the
So
put.
yes, yes. And suppose ETH price drops 10%. Now that 10% fall is covered on the Autonomint side. So if the ETH price were to fall like from today for $4,000, it falls $400. All of that $400 would be covered for you. You don't need to be concerned about that. But since the ETH price has fallen by 10% and you have taken a long position here by selling a put option, this $400 loss is also happening here. So but because this 400 loss is covered for you on the tournament side, so you are at a zero profit and zero loss. There is no loss for you. You are already covered on the tournament side. But when I say zero profit, zero loss, it's basically from the ETH perspective. I'm saying ETH price exposure. But you have already got these premiums, which is about $295 worth of premiums, which you have in your pocket. And if you subtract these premiums from the premium which you paid on a tournament side, which is $101, then this difference is your profit. And yeah, that's one of the things. Yeah.
Oh no, Rachel's
Hey,
back.
surprise,
Hi.
guys! I'm back. My
Cl
appointment got moved to next week, so we're rocking and rolling here today. False
close
alarm.
Oh,
all the windows, asking we can't do any more DeFi. She's back. We got to go back.
I'm sorry.
Um, no,
great to
no,
have
no.
you
We're
again.
Rachel. We're in the thick of trying to make some money here on selling puts against our autonomy
Let's
position.
go.
So so yeah, let's dive back in there. So since we're selling a put, that means we're making money when the price goes down. Is that correct on Deribit?
If you are selling a put and if the ETH price goes down, then this your derivative position will face loss. But whatever loss which you have faced on your derivative position due to the ETH price decrease, all of that loss is covered on the Autonomint side, because you have bought this put option here, you have bought the hedge here. So you don't need to be concerned about basically whatever your loss would be on that position, unless this loss is beyond 20%. For the 10% loss, yeah, nothing, no profit. There won't be any losses on your position. You would be delta neutral for that.
But we're making money off the open interest. Is that what you said, or what was the
We,
term that you used?
we are making money of the spreads of the options premium spread. So here $293 is the premium which you would be getting. The moment I click on this and sell this $293 would be going into my pocket, and this is the premium which I'm getting, irrespective of whatever price moves here and there. But this 293 minus the amount of money which I paid here in the Autonomint side to hedge is $111. So the difference in these two, 290 minus 111, which is like 170 or something. So that would be basically your profit. So around $170 per one ETH, which is like what less around 5%, I would say, less than 5%, right? Yeah, at a current ETH price of $4,000. So within 1 month you would
Gotcha.
be able to make around 5% per month.
I see. So the 273 comes back in the wallet, and then on Autonomous side, how do
Mm-hmm.
I paid that fee already with the options. And so if I'm executing on my downside protection here and I
Mm-hmm.
close this loan out, I close my position out. Let's go through that. Let's go through how the downside protection actually works. So the price of ETH went down, um, the value of it went down, but I'm covered, and so I have that difference between my option fee and the derivative fee the spread that I collected. Now let's, I guess, close this position out and realize my protection, I guess. Let's walk through that.
Okay, so here you can immediately, if you have opened any position here and if you want to close the position, you can just click on close here and you can close the position by clicking on this, and your position would be closed. And once it's closed, then what if the ETH price has decreased, then that losses would be displayed here. uh, net whatever premiums which you have got, so whatever the net value you will be getting here. But on the Autonomint side, if I go to dashboard here where your positions are displayed, so in one of the positions, so I will just go to one of the positions like this one. Suppose I've deposited 0.001 ETH here. If this would have been 1 ETH, then whatever the downside protection which I've got till now, this would have been showcased here. And so if the ETH price were to fall 10%, so and I've deposited 1 ETH here, then whatever the 10% of the deposit price, like for this price, that 10% value would be showing in the downside protection. And once I repay my amount, then I only have to repay the left amount, which is, so if I have minted 80% of this value 3.50, so this 80% minus whatever the downside protection which I have, that value only I have to pay, and that value would be showcased here. So you don't need to do anything, you will just come here and you will just repay your amount, and what click on this, and you automatically only the amount which is needed that would be deducted out of your wallet. The rest of the money, USD plus stablecoin, will still be in your wallet. And yeah, that's your profit here.
Gotcha. So by I'm repaying less USDA, and that's how I exercise my downside protection. So what's left in my wallet is I still have the ETH. I got my ETH back, but my ETH is worth less because it went down by 10%. But I have the equivalent amount of stablecoin, 10%, that would make
Yes.
up that price difference of the ETH being less. And so I have the ETH that I withdrew, my less stablecoin that I had to repay. So I keep that stablecoin in my wallet. Those two equal the original amount of ETH that started 30 days ago when it wasn't 10% down. Plus, I have the dollar amount in my wallet that is the premium that I collected from Deribit from the spread. Is that correct?
Exactly.
And that
Yes, yes,
amount
yes.
that is left in my wallet divided by the amount that I just withdrew plus the stable coin that I had to, pay less of is
Yes.
5%. And so that
Yes.
is a 5% gain over 30 days. Okay, I'm
Yes.
I'm tracking. Rachel, did you see that? Are you ready to
I'm ready. I'm ready, you
educational
guys.
device educational purposes only 5% a month? Does that sound
Let's
okay?
go. NFA. NFA.
Um, no, this has been fantastic running through that. I mean, yeah, we still have more time, and I really want to make sure that we showcase as many of these examples as possible. Do you have another example in mind? Should we
Yes.
maybe run through if ETH has increased in price, or we can do another use case? I'm just spitballing here, but we're
Yeah.
one
Yeah.
for
Yeah.
one so far. I think we've got a man on base. So
Yes, yes, yes. So for this use case itself, if the ETH price increases, then because you have taken a long position by selling a put option on Deribit, so there is no losses on your position here, and so zero losses here, but the profit is the premium which you have got, which is $291. So this entire premium is yours, and because ETH price has increased, so there is no need for even any hedge here also. So whatever ETH price increase, that entire upside is your. We are just deducting 3% of that upside, and the 97% of the ETH price upside is yours. So if the ETH price were to increase 10% from here onwards, so we will be taking 3% of that, and the rest 7% upside is yours. And so that 7% upside plus the premium, which is $291 which you have get here, that is entirely your profit. So yeah, so it's like, when I say it's delta neutral, then it's delta neutral, but we are not taking away your upside. You still have your upside, ETH upside.
Gotcha. So
So yeah.
let's break that down one more time. So on Deribit, if the price of ETH goes down, I just collect the premium because
Mhm.
someone paid for that put option, right? Is that where that premium is coming from? Since I'm selling it, someone else is buying it.
Yes,
And then
yes.
if it's if I'm selling it and the ETH price goes up, no one is
Mhm.
buying my put option, right? Or how does that work? So I'm just getting the ETH, the premium on ETH. Um,
Yes. So if the ETH price were to increase or decrease, or whatever it happens, this premium is already in, and there is an expiry to this. So this is like 31st October, and by 31st October, this position will expire. If the ETH price were to increase, then there is no losses on your side, so you don't have to pay anything. And because when you have to deposit some margin here, like $400 to $500 in USDT or something, and that if there are any losses, then that will be deducted out of that. But if the ETH price has increased, so then there are no losses, so nothing would be deducted out of your margin, and you'll be getting this premium there. And basically, or if you want to close your position, then you can just before the 31st October expiry itself, if you feel that no, the ETH price is very much volatile, although you are hedged on the Autonomint side, but still if you feel like you want to close your position, then you can just go to your position, and you can just click on this and you can close your position, and this position would automatically be sold by to another user by Deribit, or bought by Deribit. So that would be happening on the Deribit side. You don't need to care about that. So yeah, that's one of the things here.
so let's explain that. Who is buying that? So when the price is going up, who is
Mm-hmm.
buying a put option? So say the price goes up by 10%. So it would be 4,500 ish.
Mm-hmm.
Who is
Mm-hmm.
buying a 4,100 put option?
People who are buying this put option are basically the people who feel that the ETH price will now decrease from that point onwards. So when you're selling a put option, then there is some another user itself who is trading this derivative platform, who is taking an opposite side of the trade. And so it's there is an order book here, and your once you sell it, if you sell it at a market price, then your order will be matched directly to some other user who has placed an order to buy a put option. And so that's one of the things. But if you want to place a limit order, then you will place a limit order as well, and your order will be placed here. And Deribit will take care whenever some user will come and his position will match with you, then your order will be picked up and placed. So this is how it happens. And when you're closing your position, then same thing happens here also. You'll be just selling. You have bought this. Earlier you have sell the put option. Now when you're closing your position, you're basically buying this put option. But derivative doesn't showcase you that. They will just showcase you that you are just clicking on this and you are just creating a buy order. And when you're creating a buy order here, you're just taking an opposite position so that your earlier position gets cancelled out. And this position is basically just simple like a market order, which I just mentioned, where you just click go here and you buy put option, and that's about how it happens. Yeah.
Gotcha. So the further the price gets away from your put option, the less expensive it is, the less you can sell it for.
Yes.
Right. And
Yes.
then the closer it gets to the expiry, if it expires, that's when they say it's expiring worthless, right? Because no one's buying it. But if that's the case, your ETH is still underlying ETH is still worth more. So it's not like there's a loss there.
Yeah, I mean, if you have sold this put option already, and if you intend to hold this till the expiry, and then you don't need to be concerned about the option price, how it is moving. If the ETH price were to move upwards, then this option put option premium will decrease. But since you have already sold this put option premium at $289 here, then that's about it. You have already got that money, and you can wait till expiry, and that money will be yours. But if you want to close this position in between, then yeah, if put option price has decreased, so you would be selling at that, buying back at that price. So that difference would be some of the loss in the premium for you.
Gotcha.
Yeah.
And so on the Autonomint side, our collateral has gone up,
Mm-hmm.
and we still have the USDA that we minted. And
Yes.
so
Yes.
in bullish conditions, so I'd be using that USDA either as my margin on my Deribit account, or I'd be putting it in the DCDS, or are those probably the two most popular places to be using my borrowed collateral or my borrowed stables?
Yes. Now you can either put that minted stablecoin in the DCDS. When you are putting this minted stablecoin in the DCDS, then you are saying that, okay, I also want to own some option premiums from the other users who are taking this hedge. So you, by minting this USD plus, you have already taken hedge on your ETH, but now you can deploy this USDA in the DCDS, and you can earn premiums from the other user who are minting stablecoin and taking the hedge. And so that way you are trying to nullify whatever the cost which you have paid on this premium here with this $111, by trying to get this premium from other users who are minting stables and hedging here. So that's one of the use cases where you can just deposit this stable coin here. Other use cases is that we would be right now deploying the pools, and currently doing some partnerships with some other protocols like money markets. One of them is Molecula. So you can potentially take our USD plus stablecoin and deploy there and earn some yields on that side, or you can just park this USD plus stablecoin on a pool, LP pool, along with USDC, and that way you would be able to earn LP trading fees, or what other thing you want to do. Yeah.
Awesome. And by the way, just keeping an eye on the live stream chat here. Got to give a shout out to Stella Achenbach from UnlockDAO. She just dropped a GM and a question in the live stream chat. So she
Okay.
asked, where is the premium coming from? Does it work like prediction markets, kind of like betting? She said, sorry, late to the party if it has already been answered before. And also, why wouldn't there be losses?
So yeah, very valid question. The option premium here, we have our in-house option pricing mechanism. So this option premiums, when you are minting these stable coins, then you are essentially paying this premium itself when you are depositing ETH here, and uh, minting stable coin, and you're taking this downside protection of $838, which is 20%. Then this premium which you have paid, this will be going potentially going out of your pocket. Initially it won't be taken because we are deducting it out of your LTV, so it doesn't feel like anything has gone out of your pocket. But when you are repaying your loan back, then we'll be deducting this premium from your ETH position. So some of your ETH would be taken, and that would be sold for USDT to recover premiums from our side. And but on the DCD side, whatever premiums which we have deducted when you have minted this stable coin, so when you have deposited one ETH and minted this at 80% LTV, then we took this much amount of your USD plus stable and took that and gave that to the DCDS users. and this premium is basically now is a yield for the DCDS user who can just take this and do whatever with this premium on their side.
And
Awesome.
how
Well,
long
yeah, Stella, hope that answers everything there.
and
Yeah.
how long are we, so if I come and I want to deposit USDA or USDT into this DCDS, what's the time commitment there again?
So as of now, we have 1 month commitment, minimum 1 month commitment, 30 days, then 60 days and 90 days. The more the amount you lock in here, the higher the amount of points which you will be getting. But minimum is 30 days because when you're locking your funds here on the DCDS, then you are basically acting as a counterparty, and because we are providing a hedge for 1 month on Autonomint side, on minting side, so whatever hedge you are getting here, this is for 1 month. So that's why we require people who are depositing funds on the DCDS side, they also they also lock their funds for 1 month, so that we are matched on both side, and there isn't any unexposed positions on either of the side.
Yeah, so since borrowers are borrowing at a fixed period of time, they can expect, how long they have protection. 30 days, and when they
Yes.
renew it, they can get to 60 days. So that same concept is also on the yield side. So the people who are depositing, yeah, the counterparty, the people who want just yield on the stables and a little bit of upside from the collateral. The 5% upside in the collateral is awesome, by the way. And but that same time frame is to match up with the people that are borrowing, so you're providing the protections for the same time frames that people are expected to have the protections, so
Yes.
everything is balanced in a yin and yang.
Yeah. Yeah, and right now we have 30 days, but we would be eventually rolling out 1 week and 1 day positions as well. So you can take, you can mint stable coin USD plus stable coin and hedge your ETH for 1 day or 1 week, and similarly in the DCDs also you just have to lock your funds for 1 week or 1 day, because some of the people are short term traders and they might like to just take a short exposure on the DCD side.
Love it, love it. So let's dive into one of those strategies that are a little bit
Mm-hmm.
higher yield, some of those templates that you have, like in, say, super bullish conditions where I'm providing the
Yes.
collateral, I get the upside of my collateral, and then I'm taking my USDA, and then what am I like? Let's go degen, full degen mode here. Let's say rate cuts drop to zero, and we're going on an adventure. How do we use Autonomint to maximize our thrusters here?
So the DCDS is like one of the highest yielding product which we have, and once you have minted stable coin on the, so this is one of the strategies, and these are one of the strategies. So suppose you are doing both of these exercises, you are just minting the stable coin as well by depositing ETH and minting the stable coin, and you also depositing the minted stable coin back into the DCDS. So if you do this, then we have mentioned that the max return which you can get here is 13.5%. uh, this is when if the ETH price were to even fall also, if the ETH price were to fall, then you are hedged on your position on here, and it depends on how much the ETH price has fallen. So if the ETH price has fallen high, then your ETH hedge would be protecting for that loss, and you would be getting higher yields on your ETH hedge. uh, but if the ETH price are losses are higher, then so does there would be losses on the DCD side as well. But the net, whatever the net yields that is showcased here, which is 13.5%, which would be the max one. uh, uh, I mean, if you want to execute this strategy, then just go to here and mint the stable coin by depositing, just clicking on any of these assets. And once you have minted this stable coin, now directly go back to the DCDS and select USDA plus and deposit like whatever amount which you have minted, the entire amount or 50% of that amount, however you feel comfortable. If you deposit a higher amount, then you are getting a higher option premiums. If you are depositing a lower 50% of the amount, then you will be getting lower option premiums because your proportion would be less. So So that's a user choice and how he sees, how he or she sees how the ETH price will move. So once you've done
Awesome.
here, then yes, go ahead. Yeah.
Well, I was gonna say when BMX on here. But,
Yeah,
Yeah, I mean
BMX.
that's something we can definitely talk about for sure.
Yes. Yeah, I mean BMX, definitely BMX platform. We there also people can trade sell options by depositing capital there. So we can potentially, users who have minted this stable coin, they can potentially now go to BMX also, and sell the put option premium there. But that would be manual exercise, and potentially I think we can work out and do an integration, so that it would be an automated process for the user.
very cool.
Yeah,
By the way, Stella in the audience, it says you answered her question. I also got another comment in our live stream chat on X from Sonson, who says autonomous is the future, all caps on future. So love to see. And if you are watching right now, feel free to drop your comments in the live stream chat on YouTube or on X, and we will be sure to get to your questions.
Yes.
yeah, yeah. I think Rachel was implementing when BMX token in the DCDS.
Oh, okay. BMX token. Yeah, I mean, happy to accept that anytime. In fact, within next week also, I think we can accept that. DCDs is quite flexible and we can
Let's
accept any
go.
token. So yeah, let's do it.
Yeah, excited. Yeah,
Awesome.
we'll have two. I'll seriously, I'll hop in the TG and we'll see if we can work something out for WBLT and BMX. Because
Hmm.
yeah, it's great just seeing it working and seeing it live.
Yes.
So I guess with the what's the priorities for Autonomint? Because I would think that the primary driver is increasing the users who are executing this arbitrage between the options and the downside protection, like options on a centralized exchange, right? And then using
Hmm.
Autonomint for the downside protection. Because if we can get those number of users to a critical mass, then it seems like everyone else can just benefit off the system without having to do the complicated stuff. Um,
So
is
yes,
that
I mean
right,
that's.
or who's the target audience that you're looking to expand the most? Like, who do we want using Autonomint? Um,
Mhm.
like who's the user persona? Like, I guess, do you have a ranking of user personas, like a top three users that you would
Yes.
want coming to Autonomous?
Yes, definitely. Uh, this options arbitrage and all, it's a bit complicated for a lot of users. And while we were creating this product, we wanted the user don't wanting to have any knowledge on the option side. Someone who is having knowledge, they can explore some of these strategies. But even someone who doesn't know that, he only needs to come here and he just needs to treat this like a typical stablecoin protocol, just like another CDP stablecoin protocol. But in this, they would be also hashed. So essentially, one of the big users which we're targeting are stablecoin yield farmers, and specifically a lot of institutional and capital hedge funds who would like to hedge their exposure also whenever they're buying any token and trying to earn some yields on that. Typically, if you go to some Aave or any other money markets or any other platforms, then although you are earning yields by supplying your ETH there, but you aren't hedged on the downside. So this would be a nice platform for all the ETH yield, whatever people would like to earn some yields on their ETH or ETH LRT or maybe Bitcoin or other assets which we're accepting. And apart from that, from the stablecoin yield farmers also, that is one of the big users. They would be just minting this stablecoin, and they can then put that stablecoin in the DCTS, and they would be able to earn high yields as compared to whatever yields they are earning on any other platform out there. So, so basically, people who so these are the two top users, I would say, ETH farmers and right now ETH farmers I'm saying because we are only accepting ETH, but from the next week onwards we would be accepting CB Bitcoin as BTC as well. So people would be able to farm Bitcoin as well and earn some yields on the Bitcoin and hedge that. and over time we would be accepting other assets as well. So so yeah, these are the two top users we have. And the third one is specifically, like I mentioned, are the option traders who are basically trying to do some advanced derivative strategies and wants to earn on this option premium spreads. So those users can come in and try our product.
Let's go. Awesome. So, okay, guys, to try out Autonomint, you go to app.autonomint.com to get started /DCDS if you want to use this tool here. But really quick, Ax, I'm curious, like, since we're over the hour here, where can folks get connected with you and what calls to action do you have for our viewers today?
So, so you can go to our website, Autonomint, and you can just either firstly go to X and follow us on the X, and apart from that, go to Telegram and join our Telegram group. And I'm pretty much active there, and a lot of other community members are there, and a lot of them are farming these strategies and sharing a lot of alpha out there. So you can come and start participating there. So immediate call to action would be just come and join us in our Telegram group, and from there, happy to onboard you and answer any of your questions.
Rachel,
Awesome. I love the Sherlock, by the way, the Sherlock stamp of approval here. That makes me
Yes.
happy to see. We love Sherlock.
Rachel, I have one more patch of weeds we got to get into before we let them go.
Okay.
And that is we gotta dive into the USDA peg, and then I think, is it D bonds or C bonds, or how do we keep the USDA peg? And I think if we cover that, we have our final stone in the Thanos glove here.
Yes. So one interesting detail which I missed out here is the A bond token, which this has mentioned right now. So when you are minting your positions, USDA plus positions, and when you are repaying your loan back, then you are also getting some of these A bond tokens minted. You will only get these A bond tokens when you have repaid your loan. So what this A-bond tokens is basically these tokens are backed by ETH. These are backed by your ETH itself. But this, whenever you deposit ETH into our platform, then we divert that ETH to Aave, and your ETH is earning yields on the Aave itself from the moment you have deposited. Now all of that yields which we are accruing, that is directed to this A-bond tokens, and these are yield bearing tokens basically. So rather than just going directly to Aave and earning those yields, you can come to Autonomint and deposit ETH, and we will be directing your ETH to Aave to earn some yields right from the deposit time. And when you are satisfied your position and you want to close the position and get some hedge, whatever hedge you have got, you can close the position, and you will be getting these A1 tokens. You can then go to redeem and click on redeem here, and you will be selecting the A1 tokens which you have. And once you have selected, then you would be able to get the entire ETH back as well as the yields which have accrued on that. And regarding the USD plus stablecoin peg, uh, you can potentially redeem your stablecoin from here also. As of now, we haven't made it active, but we would be making it active so that you can redeem your stablecoin back to USDT at any time. Apart from that, you can go to our stablecoin pools, which we would be deploying uh, on mostly Aerodrome, and from there you can track the USD plus stablecoin peg and sell your stablecoin or deploy liquidity there or buy stablecoin. And so yeah, as of now the pools are not deployed, so you are not able to see the peg here. But once the pools are deployed, then you would be able to do that. And the way we are managing this peg is quite extensive as compared to existing stablecoin protocols, because existing stablecoin protocols only have interest rates as a mechanism to manage supply and demand. They can just change the borrowing interest rate and just change the supply and demand of the stablecoin. But on our side, we can change a lot of factors. We can reduce these hedging fees or increase these hedging fees, and we can provide more downside protection. And we also charge some interest rate. Right now, that interest rate is zero, uh, and but we can increase that interest rate or decrease that interest rate to manage supply and demand. So that gives us a lot of tools in our arsenal to basically manage the peg.
I love it. Thank you. Yes, that is. I think if someone watches this live stream like two or three times in a row, they they'll probably be able to go from point A to point B and explore some of
Mhm.
those serious yields that were in those templates.
Yes, yes, yeah. Th- Uh, so yeah, that's mostly about the product, and I would also like to mention that we are audited by Sherlock. We have done a pretty extensive audit, and in fact, Dees was one of the guys who has helped us coordinate that earlier. But right now we have done one audit, which is through Sherlock. It is both a private as well as a public audit, and we hope to do more audits over time. And we are also backed by some of the investors. One of them is Molly Wintermute. Molly is one of the founders of Hedgic Protocol. Uh,
Oh, nice.
she,
I've known Hedgie for a while. That's awesome.
yes, yes. Yeah, she recently backed us, and Hedgic is one of the first on-chain options protocol, which came back in 2020. And she's quite an OG and well known in this space. And getting her backing and support was quite a great thing. Yeah.
That's awesome. Anything we missed? I think we had pretty extensive, but anything we left on the table for the viewers or just to put in the archives for the repurposing?
So apart from that, yeah, other things are just this farm your luck. This is just a gamified way. So if you feel that you want to claim back your option fees or some of the points incentives from our side or maybe some of the partner incentives, then you can just select one of the cards here. Whenever you mint your stable coin, then we are giving one luck free here. This luck is basically, you can try your luck here. You can select one of the cards. If I select, I have 6 lucks right now. If I select one of the cards, I will click on reveal reward here and click on this. So so I have been
Like
unlucky here.
like one of those magic 8 balls. Like sorry, no.
Yes. Yes. So just wanted to gamify some of the things here. In one of these boxes here is the option fees which you can claim, and some of the boxes would have the points, excess points which you can come and claim. And you can either get this lux for free when you're minting stablecoin, or you can also pay $5 and you can get some of these luck chances. So that's just one
Yeah,
of the gamified.
the most
Yeah.
surreal future or the most ridiculous future will be when the farm your luck is the primary income generator for Autonomint.
Yeah.
Just the degens are like, I can't figure any of this out. I'm just gonna go click these 9 cards and see what happens.
Yeah.
I totally forgot about farm your luck. Such a great feature. Yeah, well done, guys. Well done there.
Yeah. Yeah.
But yeah,
Yeah.
awesome. That's all I have for mine, and it's been great to just personally get an update on all this. I'm sorry I haven't checked in a bit, but great to
Yeah.
have you on the live stream. Thanks for answering. Kind of last minute, and I know we went through some technical difficulties. Even though our podcasters are completely blissfully unaware because they're listening to this on their commute without any basis of start time or end time. But yeah, we made it happen, and I'm really glad we did.
We made it through. We made it through the technical hurdles. I mean, that's kind of like if we were doing a Twitter space. It's kind of like a rite of passage when you're starting. So,
Yeah.
so
And thanks a lot to you guys, and was pretty much exciting, and all the questions were quite relevant. I guess these helped clear out a lot of things which where I was sounding a little bit complicated for the user. So thanks for doing that. And yeah, great time here.
awesome,
Of
Axe.
course.
Thank you so much for joining. And lastly, where can people connect with you individually? Like, what's your handle on X on socials?
So my handle is 0x underscore AKS. People who will join our Telegram group, they can see me there, and I'm pretty much active there. And I will probably, yeah, they can just join the Telegram group and they will see me there. Yeah.
Awesome. Well, thank you so much for everyone that tuned in. I see Spiral dropping comments in the audience. Stella Achenbach from Unlocked Out, thank you for joining. Everyone else, thank you for taking time out of your day to join and to learn about Autonomint. And we will see you on the next Let's Ride.
Great.
Yeah, thanks
Yeah.
everybody.
Thanks.